Welcome to the Florida Real Estate and Entrepreneur Podcast, where we interview the best and the brightest business and real estate leaders. Our mission is to inspire and help 1,000 entrepreneurs to start and succeed in real estate and entrepreneurship. We will give you the exact playbook to succeed in your business through the experience of those who blaze the path. We're bringing the what's working today directly to you. Let's get started. Welcome back to the Florida Real Estate and Entrepreneur Podcast. Today, my guest is Chris Picciurro, a CPA and friend of the seven-figure flipping community and all these crazy real estate entrepreneurs that I know. Chris has more three-letter designators behind his name than I can even spell or say. He's a CPA. He's got an MBA. He's got a couple other designators. Honestly, I don't even know what they mean. This guy's got so much training and experience in the tax world that he's probably second to very few in the United States when it comes to taxes. He is the founder of Teaching Tax Flow, where he's teaching business owners and real estate professionals and others all about taxes. Chris, thank you so much for coming on here today.
My pleasure, Adam. I really appreciate you having me on this podcast. I don't take any of these opportunities for granted, and I'm excited to share a little bit of information. I hope that the listeners in the community will take a tidbit or two back to their own personal situation. I'm a big podcast listener to a variety of things. I love to listen when I'm out for a run or what have you. So yeah, it's a pleasure to be here. Especially love I'm originally from Michigan. I think you are also, if I'm not mistaken.
Yeah, that's a Barry Sanders jersey behind me.
B. Sanders, yes. I was there when he hit 2,000 yards against the Jets back in the old Silverdome. So grew up just outside of Detroit, very blue collar area, and have moved about 8 years ago to Franklin, Tennessee, which is just south of Nashville, about 15 miles. But that being said, have been involved in doing business in Florida for a long time. So I started a CPA practice about 22 years ago, and we had an actual physical brick and mortar office in Winter Park, just north of Orlando, for quite a few years. We had a niche where we were helping international taxpayers or non-residents that bought property here in the United States. For quite a while, I've been blessed to work with the Florida Association of Realtors and the Florida chapter of the National Association of Residential Property Managers. So, man, I'm just thinking we've done tons of presentations in Florida. On the personal side, after moving down to Nashville, it made sense for us to invest in real estate and started off with a short-term rental, a condo, then sold that, did a 1031 exchange to a house, and now we've got a house and then own the house next to us with a couple other people. So very familiar with the state, and, it's an interesting, it's a great state, first of all. And, I really enjoy it. It's, going down there and, doing business with Floridians, definitely.
Yeah, that's amazing. And you have so much experience. Of course, you did a 1031 exchange to have an appropriate tax deferral vehicle into something like kind or larger, of course. You're an expert. Hey, I'm really curious because, you grew up in Michigan. I also grew up in Michigan, just outside of Detroit and Taylor, which I'm sure you're familiar with, the downriver area.
Yes.
But at some point, so you go to school, you become a CPA, and at some point you hit this cross section of business owners and these real estate professionals. What led you on that specific path? How was it that you got so deep in with all these real estate people?
Well, part of it is a couple things. When I was 6, 7 years old, I played Monopoly with my cousins. My older cousins would put up with me. I'm from a big Italian-American family, Sicilian-American family. So we had more cousins than we knew what to do with. And every Sunday, every weekend, we were gathering to celebrate something. Someone might have lost a tooth or something. But yeah, starting with just playing Monopoly and just being fascinated with that concept, trying to be the banker and trying to understand that different property colors have different attributes and different costs and rents and adding on. So I still, my kids will barely play with me Monopoly, but my wife still doesn't understand that if you're on, Boardwalk and you roll a 5, I automatically know that you hit the luxury tax. So I know that's pretty sad, but it's just so that I always loved real estate. It was in it was just a passion that I have. And then I would say as an owner of a CPA practice and some businesses, I'm really more of an entrepreneur than the accountant. Becoming a CPA really allowed me to connect with other business owners to help people out with some skills that, quite frankly, God gave me, and I used them. Adam, if it was up to me, I would be wearing the Old English D and playing for the Tigers, right? I grew up wanting to be a Detroit Tiger. I can't even, if you grew up there, you understand it, right? And unfortunately, just didn't have the skills to pay the bills there. But in all seriousness, though, talking about starting as an entrepreneur, my first job, I was 13 years old, and you're probably too young to remember this, but I was a Detroit newspaper boy, and I would have to ride a bike around like that video game called Paperboy and place the papers at people's houses. Now, unlike the video game where you could just chuck those papers and sometimes you hit a window and something like that, my mom made me go meet with all the customers and figure out where they want their paper. Do they want it, whatever, under their mat? Because obviously, in Michigan, that's inclement weather. So many of them have a screened in porch or screened in front door. So I'd slip it there. But the thing that taught me is that I was truly running a business. I was buying the papers wholesale from the Detroit News. I was selling them retail. And then I was responsible for all of the collections of the papers. So this might sound very crazy to younger people listening, but as a 13-year-old kid, I would have to go to strangers' houses, for the most part, knock on their doors, not in a terrible area, but not in the best of areas, and ask for money, sometimes. And then I'd have to keep track of this person paid me this much, and then I'd have to take that money and pay the Detroit News. So that really helped me start on my entrepreneurial journey. Ended up starting a little baseball card shop in my parents' basement when I was a kid and peddling baseball cards and sports stuff, and just learned about supply chain because I would take I know this is kind of bad, but I'd take my paper route money. I'd walk up to the drugstore. We call drugstores in Michigan. You can call them now a CVS or whatever, but they were just mom and pops. And I knew the baseball cards were all delivered on Tuesdays. So I would go buy all their boxes of baseball cards that they got delivered. So no one in my neighborhood could get a baseball card pack. And then I basically monopolized the baseball cards, and I would open the packs, create little sets, sell off the good cards. And there was a lot of lessons learned.
You controlled the supply and they had the demand, and now you have the ability to kind of sell at a premium. That's, man, that foresight is incredible.
It was, obviously it was before the internet, before Amazon, cell phones, internet wasn't even invented at this time. So, that was one of the things that I did for a while. But really I did enjoy the paper route. Like I said, always pretty entrepreneurial, and that started me off on my journey. And then, once I always loved real estate. And once I learned, especially when you start talking about tax preparation and most importantly, tax planning and strategy, one of the laws of teaching tax flow, which is our tax planning community, is that tax agencies are your involuntary business partner. And tax laws are written to encourage or discourage certain behavior. But a lot of tax laws are written to encourage real estate investing. It's one of the top 3 industries when it comes to tax advantages. So I can really show value to people, and I can really help people if I become an expert niche down in tax planning and strategy for real estate investors. And I appreciated those people that are investing, right? Because they're kind of playing Monopoly themselves. Some people buy and, in Monopoly, you pretty much buy and hold everything and kind of burr it, right? Because
it's like the burr. It's the burr game.
Yeah. But so that was what got me started.
I'm really interested, Chris, real quick, because you said it's one of the top 3, and I think it's pretty commonly known. You can't read an article without saying, this billionaire, every billionaire, all these people who are mega wealthy have, their real estate. A lot of their wealth is in real estate. Most of the wealth is in real estate. What are the other industries that are significantly tax advantaged?
Yeah, so agriculture and farming, I would say, has a lot of advantages, and insurance companies have some advantages. But real estate to me is the best. It's so diverse, and you can maneuver through it in a lot of tax advantage ways. It could be, it just really comes down to what we talk about diagnosing and prescribing someone's situation. So we kind of chuckled at BRRRR, but for those of you that don't know, BRRRR is basically you're buying a property, you're rehabbing it, you're renting it, you're refinancing it, and you're repeating. Now, it doesn't have to be in that exact order, but that's what's happening. So from a tax perspective, one of our other laws is tax flow and cash flow are different concepts, meaning let's say all the money you pull out of that property, the equity is not taxed. right? Because you're just pulling the equity out and you have an asset that you can deduct using depreciation, and you can get real fancy and do cost segregation studies and have income coming from. So you could have a positive cash flow, and you could have a property that's giving you tax deductions that offsets your other income, and you have really nothing out of pocket once you pull your equity out. So how many places can you do that? That's why I love real estate.
It's definitely powerful. There's so much you can do in the real estate space. In that instance, you mentioned cost segregation, or, people talk about bonus depreciation. I feel like this would be a good time. Like, I know apartment people talk about it all the time. They do the cost segregation study, get great write-offs on that sense. But can rental investors also cost seg these residential houses?
Absolutely. And that's one thing that we work a lot in people in our community. So yes, you can cost seg a residential property. It became a lot more popular with the Tax Cuts and Jobs Act of 2017, meaning that for the first time ever, real estate was eligible for bonus depreciation. So think about this, Adam. Let's assume that you have a $250,000 property, single family home, $50,000 is allocated to rent, $200,000 is allocated to building. If it's residential, you're going to have to write that $200,000 off over a 27 and a half year period, straight line. But if 25% of that building is 5, 7, or 15 year asset class, that's a $50,000 deduction for a cost segregation study. That's significant. And especially if you can use that to offset your other income, now you're talking about it makes sense. And if that cost segregation study, let's say it costs you, for something like that, $2,000. All right. I mean, $50,000 and if your tax rate's 30%, well, now we're talking, right? So that's going to be a $15,000 tax reduction for $2,000 out of pocket.
It's either give that money to the government or keep that money working for you. Spend $2,000, keep that money working for you, gaining appreciation, helping you to cash flow, but then taking that $50,000 deduction. I think this is a misnomer too that I hear all the time, Chris. I'd love to get since we kind of went a little bit deep there, I'd love to get your perspective and expertise, right? So when people say, I'm getting a $50,000 write-off, that doesn't necessarily mean that's $50,000 off my tax bill. That's $50,000 off of my income, correct?
That's correct. So there's a difference between a tax credit and a tax deduction. A credit offsets your tax. So in general, credits are more valuable. But the thing you have to remember with credits is that some are called non-refundable, meaning if you don't have the tax to offset the credit, then you lose it. Where deduction comes off your taxable income. But so what you have to figure is you have to look at the $50,000 tax deduction multiplied by your MTR, marginal tax rate. So it's one of my tidbits. I would challenge anyone listening, figure out what your marginal tax rate is. It's not the same thing as your tax bracket. Your marginal tax rate is for every amount of income, for that next dollar you have to report on your tax return. How much do you pay your business partner, which is the IRS? You have an involuntary business partner. So thank goodness the people in Florida, you all do not have a state income tax. One of the reasons my wife and I decided to relocate here to Tennessee, we don't have a personal state income tax, but you still have a business partner in the IRS. So if your marginal tax rate's 30% and you're getting a $50,000 deduction and you can use all that deduction this year, that's a $15,000 tax benefit. So MTR, marginal tax rate, it's more important than your tax bracket. There are a lot of things that go into your marginal tax rate. The best way I could describe marginal tax rate is another thing is my little 10-year-old, we were driving back from basketball practice about a week and a half ago. And he's like, Dad, if I ate a candy bar of a solid pound Hershey bar, would I gain a pound? I'm like, versus if I drank a water, that's a pound. I'm like, well, you wouldn't gain a pound from the water because you would recycle it and it's not, but if you just ate a pure pound of chocolate, you'd probably gain more than a pound. So the point is not all income is taxed the same. Not every calorie you intake, for instance, affects your body the same. So MTR is more important than your tax bracket. One other because I want to touch on this, Adam, especially for people in Florida, there's a really piece of low hanging fruit that a lot of people have taken advantage of, but people still can take advantage of that ties into the cost segregation study. That's something called the short-term rental tax loophole. So if you are an operator of a short-term rental property and you're self-managing it, you might be eligible for bonus depreciation on a portion of that property. And you might be able to offset active income or W-2 income with the bonus depreciation from that property. Otherwise, you would to be able to take these losses from rental properties, you'd have to be something called real estate professional status or rep status. But let me paint a picture. Let's say you bought a place, at the beach. You only use it 2 weeks a year or less. You bought it for $500,000, probably $600,000. Let's say it's a condo. There's not much land value. You bought it right after the pandemic in 2021, and you just put it on your tax return, renting it out, and you're depreciating that over a straight line method. Well, if you're self-managing, you have something called material participation you're probably meeting. And the point is you could potentially have $150,000 to $200,000 tax deduction by doing a cost segregation on that property and offsetting W-2 wages or retirement income or Social Security income. The cool thing is, now you'd get that by doing a cost segregation study. The cool thing with the cost segregation study is that back to monopoly, it's a get out of jail free card. So if you put that property like on your tax return or placed it into service in 2021, you could still count it for your 2023 tax return. Now you could do a retroactive depreciation deduction and make I don't want to get too technical, but make something called a 481A adjustment and put it on your tax return this year. So my point is, maybe don't stress yourself out about the mechanics. If you have a short-term rental property that you've been self-managing, that you bought anytime after September of 2017 until now, talk to your CPA, talk to your enrolled agent or tax professional about potentially the short-term rental loophole. If you're not sure what that is, I'm sure there'll be my information in the show notes. Please reach out to me and I'll help guide you in the right direction.
Yeah.
Final thing on bonus depreciation. Oh, go ahead. I'm sorry.
Let me ask one question because you cover this. I want people to understand this. So like if you're a real estate investor and you're doing some amount of hours, which I'm sure you'll tell me here shortly, that would qualify you to take an election to be a real estate professional status reps. When you get rep status, because you have 750 hours or whatever it is, Chris, you can then take that depreciation. So let's say you buy a rental, you depreciate it, you do a cost seg study, bonus depreciation, all of them 1 year. You can take that full depreciation against your active income if you are a real estate professional. Now, what if I'm just a high earning W-2 person? I want to go through a couple scenarios here because we have a lot of people like this. They're making a couple six figures and maybe they're buying a rental here and there. Can they get real estate professional status? And then if not, what it sounds like is this loophole for short-term rentals is another methodology if they're not spending the hours to get this kind of depreciation against their active income.
Great question. So let's backtrack for 1 second. In general, rental real estate, owning rental property is a passive activity according to the IRS. So losses from passive activities are suspended if your income is at married joint over 150,000 or single 75,000. Okay. That's the default. The way you would be able to deduct losses from a rental property, and you might be saying, why would I have a rental property with losses? That doesn't make any sense. You're still making cash, like your cash flow is positive, but you're able to take bonus depreciation and all the depreciation deductions. So it's not that you're losing cash flow. It's a concept that you would have a paper loss, okay? To be able to take that paper loss against active income or W-2 wages, you would have to be something like Adam, you mentioned, rep status, real estate professional status. And it would be very tough for someone that's a full-time employee, almost impossible to get that. You have to have at least 750 hours into real property trades or business hours. So for instance, like there's a list on the IRS website, but managing property, managing construction properties, doing the proper, basically managing your rental properties, for lack of a better term, but it could be the construction. Maybe you're really handy and you built the fence around the rental property. That's the easy part. The hard part is it also has to make up more than 50% of your professional time. That's where it gets really tricky. So if you have a full-time job, it's going to be tough it's almost impossible to be rep status unless your full-time job is being a mortgage real estate broker or doing things in the real estate industry. Here's the good news though. There's a little bit of a loophole. I wouldn't call it a loophole. If your spouse is rep status, and you file jointly, then you're rep status. So if you have that W-2 professional, let's say they're making $400,000. I've seen $1 million on the W-2 and they buy a rental portfolio and the spouse is managing it and makes rep status. Now you can do the cost segregation studies and take those losses from the rental properties and offset the high W-2 wages. So if you're single and you're a high W-2 earner, congratulations, number one. Next time you go on the dating app, make sure you search real estate professional, because you're going to want your next spouse or your future spouse to be a rep status. That's kind of a joke, but I don't even know if you could search that. I've been married way too long to know
you should be able. The guys, I mean, I've been married for 19 years, so I don't know either, but I'm pretty sure it's all algorithm based now, and you can search hashtags, and there's probably apps for that. So no, I think that's really important, because obviously I'm steeped in the real estate community, a lot of real estate activities, all the rep status, but there are all these like high W-2 earners who come and they invest in multifamily, or they want to buy rentals because they want to offset some of that income. And I don't think that they all fully understand, in order to have the most, to be able to depreciate and take all that bonus depreciation, you do need to have either real estate professional status, or you need to have an Airbnb where you're managing it and all that stuff you said. So no, that's really good information.
I'll throw one more thing out there just to ease someone's mind. Here's another thought. Let's say you are in the 35% marginal tax bracket. Okay. And you're some type of, I don't know, you run a business, or you're just whatever you do, and you have rental properties that are kicking you off positive cash flow, right? The thing is if you were getting dividends, or if you're getting interest from the bank, you'd be paying 35% of that to your business partner. So running a cost segregation study, even if you can't take the entire deduction today, you don't lose it. It just carries forward. So if I were to go to someone that's in the 35% marginal tax bracket and say, hey, you're going to invest in this duplex, or this, maybe a syndication. It's $100,000, and you're going to get 10 grand a year for the next X amount of years. And you're not going to pay tax for the next 8 years on any of that money. That sounds really good. So I don't want everyone to feel like, man, I shouldn't do it. The cost side could be powerful to get some of those deferred, to get the passive activity loss carry forward to offset future gains. Adam, let me ask you a question. Do you think tax rates are going to go up or down?
They're certainly not going down.
Right. So having those deductions to carry forward into future years isn't the worst thing in the world.
Yeah, I think it's really powerful. I want to talk a little bit too, Chris, about being a business owner, because we definitely attract a lot of real estate people, but also other business owners. What are some of the advantages of setting up a business, and what is setting up a business? Because I think we get this question a lot, and I'm sure you answer this question no less than 10 times a week. There's people are like, do I need an LLC? What is an LLC? How do I get an LLC? Do I need a business bank account? How does the money have to move? How does that help me for taxes? And, there's a component of the LLC that's asset protection, and a component that is kind of goes to the tax side. So can you maybe unwind some of that for people?
Absolutely. Well, remember I said, we always say in teaching tax law that the tax agencies are your involuntary business partner. Tax laws are in to encourage and discourage certain behavior. And what does that mean? When you're a W-2 person, you'll pay tax on your gross income. You get no deductions. You might throw some money in a 401k, but guess what? You're going to pay tax on that in the future, whatever rate your business partner says your rate is in the future. Maybe you could put some money tax deferred or tax free into daycare or something, but ultimately you're getting taxed on your gross income, and you have no deductions, even if you work from home. The advantage of being a business owner, because this country was built on entrepreneurs, in my opinion, is that you pay tax on your net income. So you get to deduct all your ordinary and necessary business expenses before you have to share your profit with your business partner. That includes home office, vehicle, anything ordinary necessary for your business. Now, your business, think about my paperboy example. I was technically in business. You don't have to have an LLC, a corporation, make an S corporation election or anything to be in business. Just being self-employed means you're in business. So I don't want people to feel like I've got to file something specifically. Now, obviously there's some businesses you need occupational licenses and the proper insurance and that sort of stuff. But from a tax perspective, if you're self-employed, even if you drive an Uber around, you're in business. Then it comes down to, how do you want this business to be taxed? Each type of tax entity has pluses and minuses. You're right. The most commonly asked question we get is, should I set up an LLC? So LLC stands for limited liability company. If I had $1 every time someone called it a limited liability corporation, I don't know if I'd be working anymore. I probably would, because I like it. But so what does that mean? That means that you are creating an entity separate from yourself to operate your business. I'm not an attorney, so this is legal advice, but I'm talking from the tax perspective. From a federal tax perspective, that entity is a disregarded entity. If you're the only owner, that means the IRS says, hey, if you just form an LLC and you're the only owner, we don't really care. You're still self-employed. But what the LLC does is it does, like you mentioned, provide you some asset protection. It also can provide you some anonymity. Think about if you hire a bunch of people and you issue W-2s, or if you are more like 1099s, you don't want your social security number on all the tax forms. It does make you seem more legitimate as a business owner if you're an LLC. So if you do form an LLC, which is pretty easy to do, then you just have to obtain a federal identification number, which is the equivalent for a business of your social security number. And then you're going to want to set up a separate bank account to keep track of the money that's going in and the money that's going out. Even if you're self-employed, I really like that idea of setting up a separate bank account just so you can see the money coming in, money going out. And there's times, as you know, if you've been in business for a while and you've got a loan, you got to take some money out of your own pocket and put it in. But hopefully there's enough more times where you could take the money distributing out to yourself. So the LLC is a great starting spot. And then from there, your LLC can elect to be taxed as an S corporation or a C corporation. And that's where things get a little more complicated, a little more expensive from a tax preparation and compliance standpoint, but it might be worth it from a tax saving standpoint. So the beginning, I would go with just a single member LLC. What I see way too much are people jumping into S corps. And gosh, there's a lot of negative consequences for rental properties to being in an S corp. The two main negatives of the S corp is that if you have an S corporation with a rental property and you deed it out of the S corp and put it back in your personal name or put it into a separate entity, that's considered a deemed sale at fair market value. So it could be really, really negative. World that specialize in real estate as much as we do, and half of us have these t-shirts that say no rentals and S corps. No one knows what the heck we're talking about when we're walking around the streets. But when we really get nerdy at our conferences, then everyone kind of chuckles at it. The second issue with S corps is the concept of losses. So, Adam, I know like in the syndication world, right? Let's say you put in $100,000 into a syndication and you get allocated $200,000 of debt. Okay. So not to get too geeky, but your tax basis, if it's an LLC, is $300,000. So you can deduct losses up to that basis of $300,000. 100 you put in, 200 a debt basis. With an S corp, you can't deduct losses from S basis. So you can only deduct up to that first $100,000, which really is bad when you're talking about real estate and cost segregation studies. So the S corp, if you're a real estate investor, it's going to make sense. If you're flipping and wholesaling and assigning a bunch of properties, if you run a business, let's say you're a plumbing contractor, the S corp's going to start making sense probably when you get to about $150,000 of net income. Because the advantage of the S corp is that you can mitigate some Social Security and Medicare tax, which is great. It's just you still have to pay yourself on a W-2, and there's just a lot of compliance costs. So
if you were to compare two businesses, Chris, that do $150K in net income, and one is just a typical limited liability company, single member, and one has taken the S corp election, what's the difference in taxes roughly for those two businesses? That's an amazing question. So the answer, because we all, accountants and CPAs and attorneys always say it depends, right? The answer is it depends. But I'm going to answer the question. When you're an S corporation, and this is one of the top 5 things, in my opinion, that are getting audited by the IRS now, is that you have to pay yourself a reasonable compensation. There's a concept of reasonable compensation for the services rendered to the S corp. So depending on what we want as a tax planner, we want that reasonable compensation to be as low as possible. Okay. So let's assume you run a plumbing contractor. You're a one-man band, right? And your net income is $150. And we can make the argument that you should pay yourself $80,000 a salary. Does that make sense? The remaining $70,000 is considered a dividend. Okay. In that fact pattern, your savings would be $70,000 multiplied by 15.3%, which is the Social Security and Medicare tax. You'd save about $10,000 being the S corp in that case. Other things to consider though, if you're trying to save for retirement, now you're an employee, not self-employed. So you'd have to have a different type of retirement plan. Your Section 199A or qualified business income deduction, which came about with Tax Cuts and Jobs Act, up to 20% federal deduction. Now for the S corps, only on your $70,000, not the $150,000. So there's positives and negatives, right? Now you have to hire yourself and run payroll. So you're talking, a few $1,000s at least of administrative costs. Now, if you were the plumbing contractor and you said, look, I'm half retired, I only work 2 days a week, but I want to be an S corp, and I could say your salary should be $80,000, but you only work 25% of the time. That $80,000 is based on 2,000 hours. You only work 500. Now I can substantiate a $20,000 salary, and now the S corp makes sense. So really that saving, I just had a real life situation where I have
I was working with, doing a tax plan for someone. He's a dentist, so the Social Security and wage max is, I think, like 180 or something. So in other words, he's a W-2 person somewhere else, makes well over $300,000 in a W-2 role, but also freelances, and was like, hey, should I make that LLC an S Corp? The problem is, I'm like, all that would do is cost you more money because you're already maxing your Social Security fund, and now you're going to be paying more into payroll taxes. Your example of S Corp makes some sense, but not always does it make sense.
Yeah, my favorite answer, similar to the military, is when somebody asks us something, we say it's situationally dependent. Depends on the situation.
Mm-hmm.
So no, that's
exactly.
That's good. Yeah. I think that's like probably one of the most common things. And people, when they get their business up and running and it starts to build the bank account up and they feel comfortable taking money out of the business, they just don't know what they don't know. It's the best time in the world to start talking to your CPA, call Chris, figure out, hey, I need to do some tax planning. I have 2 more questions for you. But before I do that, I would love for you to talk to folks a little bit about the difference between getting your taxes done and doing tax planning and strategy planning, and when it's appropriate to do that. Probably not December 31st this year, or right before you submit your taxes in October, which is what all the entrepreneurs are doing.
Well, great question, because we only have 3 laws of teaching tax flow. We already talked about cash flow versus tax flow. We talked about the IRS as your business partner in other states. Third law is that your tax return's a verb, not a noun. So it's something that you should be thinking about all year round. There's never a bad time to do tax planning. The best time would be when you're kind of at a crossroads, or you have an event in your life that you need to figure out which route to go. As far as the S Corp election, that's something. The good thing about the S Corp election, for example, is you have the first 75 days of every year to make a retroactive S Corp election for that year. So, let's say it's January 31st, 2024, you could still make the election for 2024. You can't go back. So there's never a bad time for tax planning. The difference, here's the best way I could describe tax planning and strategy. And actually, we recorded a podcast. It's been one of our most popular podcasts. I'll send that link to you. Tax planning versus tax strategy.
Yeah, that's good. I'll put that in the show notes.
Sweet. So tax planning is like staging your house to get you the best price possible, legally and ethically. You're not changing the house, you're not lying to the buyers, but you are getting it staged so it looks amazing. Where tax preparation is very transactional. That's the sale of the house. Your house is going to sell at some price, but do you want the best price possible? And sometimes you got to invest a little bit into the planning, a little bit into the staging to get a huge result. Or sometimes the stager might come in and say, look, it's going to cost $10,000 to stage this house. It's not going to, and your realtor is going to say it might increase the price $11,000. It's not worth it. But here's the thing I want to leave you with. The IRS spells out theirs, right? By only doing tax preparation or only having your taxes prepared, it's very reactive. Who's picking your tax? The IRS. They are, theirs. Or are you picking your tax? If you want to pick your tax, you just have to do tax planning, legal and ethically. You don't like your numbers? Try to get them staged to the best possible. We say manipulated. Manipulated sounds like such a bad term, but really it's not. I mean, and that entails so many different, depending on your situation, that could be a number of different strategies. And ultimately, Chris, we want the lowest marginal tax rate.
I have a good example. Like May, June timeframe. I'm looking at projections. I'm looking at cash coming in, and I'm like, oh my gosh, I'm going to get crushed on taxes this year if this rate keeps going. So I do some tax strategy planning, and I get some recommendations like, hey, what are what can I do that are most tax advantaged? And it was, the stuff we know. Go buy some apartments, okay? Or go buy a car that's over 6,000 pounds in your business. Things that you could depreciate and defer taxes to a later date. And I went and bought 2 apartments, 224 units, and I'm getting a beautiful bonus depreciation on that. I was able to significantly reduce my tax burden, just because I did the planning. I didn't know for sure. I'm obviously not a tax professional, but I knew that the amount of money that was coming in was going to be problematic from a tax perspective. And my business partner was going to want a big chunk of that unless I did something else, put that money into a place that grows for me somewhere else that's tax advantage. So it is critical. It is definitely critical.
It is. So in one of the other examples I use is just driving. Like, think about what you did was very smart. you knew you had to go somewhere. And instead of just rolling out of your house and driving, you looked at the GPS, and the GPS said, there's a massive accident on the interstate. It's shut down. If you go that way, it's going to be 2 hours to go 20 miles. So maybe it takes you an extra 10 minutes, but you're going to go around that and you're going to get to the destination. And that's what you did. But if you don't do tax planning, you're just jumping in your car and driving and without any clue of what's going on.
And you're mad when you're stuck in traffic because you hit the accident. Yeah, that's good. Hey, I got 2 final questions for you, Chris. This one's a little different. A lot of people ask, if you can go back and give yourself advice when you were, say, 20, what would it be? But I would love to hear, because you're a business owner, you're an entrepreneur, your skill set is a CPA, but you're really an entrepreneur and a business owner. So 3 years ago, so we put ourselves in 2021, if you could go back and give yourself advice 3 years ago, what would it be?
Ooh, that's a good question. I would say so 3 years ago, we launched this teaching tax flow. We launched it about a year and a half ago, but it was all in R&D. So there's a couple things I would have changed. I would have put more time into investigating anything into our technology stack, more long-term than short-term. So we built an educational library on Kajabi. We outgrew it into a custom WordPress site. I could have avoided a lot of expense, a lot of headache if we would have just started on a custom WordPress site from the beginning. But my decision, and I had other people that I consulted, but ultimately it's my responsibility. So really look at the future when you're thinking about, and you're running a business, a technology stack, or if you have a cement company, you don't necessarily worry if you're on Microsoft 365 or Gmail, right? But what type of equipment are you going to use? Think about what you need in the long run, more than just putting out a fire. So I know it's not the coolest answer, but it's true.
That's a great answer. I think, I mean, we see this is pretty prevalent in the real estate space, right? Like, we have a lot of technology in our businesses. Everything's basically tech based, and people are always kind of like, what CRM do I get? What this do I get? What this do I get? And they're making, short-term decisions. That's a really hard decision too, because you don't know where that business is going to be in 3 years. You're confident you're doing it and you're courageous doing it because you're an entrepreneur, but you're also a little nervous. It's like, I'm not sure if this is going to meet what I want it to do. And do I want to invest up front? And you're saying, bet on yourself, be true to what your business plan is. If you think you're going to have this kind of growth, make sure you're making the right decisions on your technology that you're going to invest in for your business. Because it is an investment, right? That is an investment into your business. It's not just an expense. It really is an investment if you do it right.
That is correct. Just like your professionals. It could be a mentor, it could be an attorney, it could be an accountant, it could be a mortgage professional you work with. Surround yourself, build what we call your board of directors with the people that are an investment, you're investing in that relationship. You're not looking at it as an expense. Think about that person and everyone that surrounds you to help you grow your business as an asset. And if you think that they're an expense and not an asset, then you're probably working with the wrong person, or you might be out of touch a little bit too. Like I look at, God bless my parents, but they probably haven't bought a stove in 25 years. So they're kind of out of touch with the stove market, right? So they've got to understand that. But yeah, that's my other piece of advice.
Yeah, that's great. That's great. Chris, for those who may want to do some tax planning, or they want to see what you have going on in the teaching tax flow community, how can people get involved? Where can they find you at? How do they become a part of that group? And if they want to work with your team, how do they do that?
Mm-hmm. Well, thank you for asking. The best starting spot would go to my website, chrispicciurro.com. Very hard if you're driving around. So I'll give you that for the show notes. The other thing, this is an easy one. Just dip your toes in. We've got a podcast called Teaching Tax Flow, the podcast, and we have a free private Facebook group called Defeating Taxes. So if you just go to defeatingtaxes.com, it'll take you right to that group. As long as you're not a knucklehead, we'd love to have you in there. We have a bunch of professionals in there. We have a bunch of people asking questions. People can ask anonymously. But really, we are working together to legally and ethically reduce the tax you pay in your lifetime. That's the mission of Teaching Tax Flow. And I'd love to hear from people.
Yeah, I love it, Chris. Thanks, man. I appreciate you taking the time out of your day to come on and talk to the folks about taxes. It's one of those things that, you kind of don't want to talk about. You'll figure it out later, but you need to. And this has been incredibly insightful, man. I'm so grateful for you.
Well, my pleasure. It's been an honor to be on the podcast, and everyone have an amazing day.
Thank you.